If you had to pick just one ETF for the next decade, would you choose growth, income, or would you choose semiconductors? Well, today's audience requested ETF showdown is between tech growth versus dividend income versus semiconductors. Let the battle begin. You're watching ETF Battles, and I'm Ron DeLegge. Welcome to our original series. We're in the midst of season 7, and we're so glad to have you watching. Be sure to join our community by hitting that subscribe button and send me your ETF battle requests in the comment section below. Give me your exact ETF ticker symbols. We can do double, triple, and quadruple headers, so make it good. Today's program is sponsored by Direxion, and they've rolled out recently 4 brand new single stock ETFs with 2x daily exposure to Adobe, PayPal Holdings, Texas Instruments, and United Healthcare Group. To explore the full lineup, head over to Direxion.com. Today's ETF contest was requested by a viewer named Eric, and he wants to know if we were stuck on a desert island. If we were stuck on a desert island, what would we choose? What would he think was the best for the long run? It's a contest between SCHD, which focuses on dividends, QQQM, which is tech growth, and then SMH, which is semiconductors extracted from that technology group. Thank you so much, Eric, for today's contest. Here to help us dissect it is a duo extraordinaire. We've got Tony Dong, independent ETF analyst, and Mike Akins, founder at ETF Action. Gentlemen, welcome back. Great to see both of you.
Thanks for having me, Ron.
It's great to be here, Ron.
So our 4 battle categories are cost, exposure, strategy, performance, and mystery. The mystery category is where you, our judges, can choose any factor or criterion that you feel is crucial to today's contest. The judges can also nominate wildcard ETFs if they like something elsewhere better, or they can opt for split decisions. I've got the scorekeeping duties, and at the end of the program, we will declare an overall winner. Remember, none of the outcomes, the battle outcomes on this program are ever predetermined or known in advance by myself or our judges. The first category is cost. Tony, please get us started.
Okay, so one thing you might notice is that the more specific you get with your exposures, like going to sectors or industry, higher expense ratios tend to be. Similarly, if you're licensing a very hot benchmark like the NASDAQ 100. So on the cost thing, SCHD absolutely floors both with the lowest expense ratio. QQQM sits in the middle. It's worth noting that QQQM is cheaper than QQQ, but since QQQ is now converted from a unit investment trust to 40 Act ETF, that expense ratio has come down a bit, but QQQM still has an edge. SMH at 35 bips is pricier than both, but when you look at the average fee that tends to be charged for these industry-specific ETFs, it's actually quite standard. So just on cost alone, is going to go to SCHD. I'm not even going to look at the bid-ask spreads here because it's just too far for any of them to come close to SCHD. And sums it up for me. SCHD wins in terms of fees.
That's a strong start. Mike, how do you see it when it comes to cost?
I mean, I think they're all pretty cheap. They're all extremely liquid. So they're all great vehicles for what they're trying to achieve. From a pure cost basis, Schwab is coming in the cheapest with SCHD at 6 basis points. So I agree with Tony on that front. But it's the furthest thing that's going to matter between what your experience is with these, because they are very unique, as we'll get into as we continue our discussion.
Yeah, and that takes us to the next category, which is exposure strategy. So Mike, break it down for us.
Yeah, so you basically got 2 kind of targeted strategies, broader in nature, but targeting QQQ, kind of thought of as an innovation leader. A large cap growth is how we classify it here at ETF Action. SCHD is large cap value. It's a dividend strategy, but focused on the broad market, pretty diversified portfolio. And then you have SMH, which is purely focused in on semiconductors. When you look at these 3 strategies, they are completely different, right? So SCHD is going to give you a diversified basket of U.S., primarily large cap companies that have a value tilt, that have paid a nice dividend relative to the broad benchmark. QQQM is the NASDAQ 100. We know what that is. It's a tech-focused industry, but does have allocations to other sectors. Very high allocation to the top 10 being kind of that Meg 7 stocks. It's also, going to have a much higher valuation multiple, but much higher growth metrics. And then the semiconductors are what they are. I cannot provide a winner for exposure and strategy because they all deliver what they're supposed to deliver. They're passive strategies. So I really can't tell you who's the winner from exposure, cost, or strategy in terms of the fact that they all deliver what they say they're going to deliver quite nicely. That being said, as we get into performance, I'll tell you what I want to hold if I'm Tom Hanks stuck on an island.
All right, that sounds good. With a beard, like looking like a wolf man. So
yep, exactly.
And I can't
With
wait
Wilson.
to that. Yeah, get your wolf mask while we shift to Tony. You might need it. Tony, how do you see it when it comes to exposure strategy?
Well, I think the NASDAQ 100 is a nonsensical index. There's no economic basis for taking the 100 largest companies listed on a particular exchange, excluding an entire sector, financials, and market cap weighting the next. And moreover, some of the proposed changes to the index rules that would allow for fast-track inclusions of IPOs such as SpaceX and OpenAI.
I hate that.
Yeah, I don't like it either. I don't like it. You're going to become a forced buyer. You're going to become exit liquidity for every SpaceX and OpenAI employee. So for me, the NASDAQ 100 exposure is nonsensical. If you wanted an explicit tech tilt, there's an easier way to go about it than without getting Costco, Walmart, and Pepsi, which are fantastic companies. But if tech's what you're after, what are you doing there? You can get explicit large cap growth at a cheaper expense ratio. You can get explicit tech tilt at a cheaper expense ratio. So for me, it's just, it's an artifact of the past. SMH, on the other hand, market cap weighting a narrow industry has led to outperformance because it's largely let NVIDIA run over the last decade. But now, if you're buying now, NVIDIA is like, 20% of the fund around there. So buyer beware, right? I know on a price to earnings growth basis, NVIDIA still looks cheap, but I don't like to dabble in super cyclical industries. Whereas SCHD's methodology makes a lot of sense for me. Starts by requiring 10 consecutive years of dividend payment. Then there's that composite screening on 5-year dividend growth rate, dividend yield, free cash flow, and return on equity. And the portfolio is reconstituted fairly frequently, so there's a lot of turnover. But as Mike mentioned, you get a very good large cap value bias, which I think at this point in the market cycle, and judging if 1999, the dot-com bubble, is ever a parallel, I think large cap value and international will do well for the next decade. One of the strongest predictors of future returns is starting valuations. And right now, large cap growth is looking as expensive as it's ever been. So for me, I'm going to go with SCHD again. It's simply a good ETF. It's going to go in and out of favor, but be patient and just drip the dividends.
Thank you for that awesome analysis. Now we shift to performance, and give us your analysis on that front, Tony.
SMH has destroyed QQQ, which has destroyed SCHD in terms of historical performance. The semiconductor bull market has been astounding. It's been one after the other in secular growth drivers. You've had tailwinds from video games, cryptocurrency mining, AI hyperscalers now. There's bottlenecks everywhere in the fabrication plants in Taiwan. There's bottlenecks in memory in South Korea. There's a reshoring effort with Intel. Chip designers are competing heavily. There's just been a perfect storm of growth drivers that has propelled this to 30% annualized returns over a decade. That's hard to match. If we're going by historical performance altogether, SMH wins hands down. But again, starting valuations, one of the best predictors of future returns, along with fees, by the way. And if you look at it on a forward price to earnings ratio, SCHD, lowest one, and the lowest fees, which, if I was to look at it from a forward-looking perspective, and you can put my name down on this, I don't mind. I'm going to go on the record, and I think that SCHD has a chance of outperforming both, a good chance actually, over the next decade. But you got to be patient and resist. You got to be a contrarian with this kind of thing. And I think if you're going to express a contrarian large cap value thesis, a dividend-oriented strategy, funny enough, it's a pretty good way of capturing it for cheaper than a lot of brand name value ETFs. So, but in the interest of this competition and the historical performance metric, SMH wins here.
Thank you, Tony. And we appreciate you sticking out your neck and having a viewpoint. That's why we like to have you on the show. And great job. So, Mike, how do you see it when it comes to performance?
Yeah, there's obviously, we've been in a mega cap tech driven in market for over a decade now. So as such, semiconductors has led the story, though I will tell you, up until a few years ago, software led that tech story, and then it turned into hardware and technology with the AI build out. So it can go very quick. If you look at the drawdowns on SMH, they are sharp and they are severe, even in the last 10 years. So there's an extremely high risk profile of SMH relative to even QQQ, which has a very high risk profile because it is, right now, I didn't mention it in the cost exposure, I should have, but, QQQ actually has a much higher overlap with SMH, 33%, because 34% of the Qs right now is semiconductors. Because of how much NVIDIA and the others have grown. And then you have SCHD, which is a very well-diversified portfolio, but it has not even come close to keeping up with the others. It hasn't, even kept up with the S&P 500, which has a more growth tilt over that time period. From that perspective, we don't play in the game of past performance. We play in future results. I'm not quite as confident on saying, hands down over the next decade that SCHD will outperform either. I think nobody really knows what the next decade brings, what's going to drive growth in our economy, et cetera. So I will caveat what I'm about to say with, you should never find yourself on a deserted island only buying one investment. But with that caveat, I would hold SCHD just simply because I think it'll give you a smoother ride. I do agree with Tony. Valuations are extended. We have been living on, in my opinion, borrowed time for a real correction in the market. And SCHD should hold up better in that scenario simply because the names inside of it haven't ran like the others. But I don't think, I wouldn't count out semiconductors or the Qs. We just don't know where AI is going to drive this market, and I wouldn't feel comfortable not holding some of that exposure, simply because if you don't hold it and it continues to run, eventually we are going to have that correction, but it might be 100%, 200% from here before that happens. So I will take SCHD. If you put me on a desert island, I have to hold one, but it's a tough conversation for me on these three tickers.
Great analysis, and I concur with you that definitely we're way overdue for some sort of correction, and certainly, as you pointed out, SMH being higher beta, certainly more downside risk there. Also, too, by the way, if we find ourselves on a desert island, I think finding the next best investment for the next decade is probably the least of our concerns. We're just worried about tomorrow's meal and finding it.
Exactly.
So now we shift to the mystery category, where our judges could give us a certain factor or thing that they feel is crucial to today's contest. So, Mike, what is your mystery battle category, and which of these ETFs wins it?
Well, I think I'll throw my mystery category in there being don't try to time the market. I do believe that you can tilt and you can agree that there are certain things look out of whack and maybe adjust your portfolio as such, but to try and fully time in and out of the market, there's been dozens and dozens of products and managers that have said they could do it since I've been around, which is going on 30 years as a professional now. I know it looks like it's about 5. But so to that extent, my thing is diversification is key. I think fixed income still does work. It got a little out of whack there 4 or 5 years ago where duration was silly and you needed to be careful of that. But a 60-40 portfolio would be better. So to that extent, if you are stuck on a private island, there are some great low cost, well-diversified multi-asset fund-to-fund strategies out there. Take a look at the iShares lineup. They've got, AOK, AOR, AOM. They allocate to different sets of the market. So just a simple growth portfolio of 60-40, I think would be the better way to think about it. And that will be my kind of wild card ticker for this segment, being that don't find yourself in a position where you have to pick one or the other. Play the market, get a smoother ride, stay invested. And that's my Mr. category.
Tony, you're up next. What is your mystery battle category, and which of these ETFs wins it?
Yeah, it's going to be index governance, and I alluded to it with the whole SpaceX and NASDAQ fiasco. It leaves a really sour taste in my mouth. I understand that running an index is a business, but the reception of this has just been abysmal from everybody.
Thank you for harping on this. I really appreciate it.
Like, notwithstanding that the Nasdaq, as I mentioned, is already a very like non-economically sound index, but just SpaceX doesn't make money. We know it doesn't. It doesn't mean that the valuation.
And we're helping someone that doesn't need any more help, right? Elon,
it's just
do we need to help him any more than he? Go ahead.
I just can't get past that. And I don't think SCHD is going to include that just by virtue of the fact that SpaceX doesn't pay a dividend. So there's no way they're going to get included. Whereas SMH, I mean, I don't really know how their market vector indices work. I know it's like VanEck's like own little shtick there, but like it's done its job. But I don't see either of those two, like they're not going to include some of these like mega cap unprofitable IPOs right off the bat. But you bet the Qs are, and it's going to become a big part of that eventually. I don't know. Indexes are a business, people. Don't fall for the whole passive versus active debate where even like the SPIVA study, that's commissioned by S&P Global. That's theirs. It's all a tool to get licensing and to get those fees, and they'll do what they think is necessary to get these flows from retail. And yeah, I'm sure there's a lot of people that want SpaceX, but if you don't want SpaceX, you want no part in these mega cap unprofitable IPOs, maybe look at your index exposure a bit more and understand that the Qs have always been a marketing tool. That's it. So again, another vote for SCHD for me there.
Got it. We've moved to the part of the program where our judges can give us their overall winner. Tony, give it to us.
I like SCHD. If you look at it less like a dividend strategy and more like a large cap value strategy at 6 pips, great value. Yeah, sure, the income is nice, but most of you are just reinvesting it anyways. The good news is that it also excludes real estate investment trusts, so it's mostly qualified and fairly tax efficient, but you're going to have some drag there. Something like SCHD, keep it in your Roth, drip the dividends when you're not reinvesting it. And again, like expected to underperform in years where the value factor underperforms. But if you run a factor regression on it, it loads very highly to value, almost as much, if not more, than some of the competing brand name value factor ETFs at a fraction of the price. Schwab has really hit it out of the park with this. And I think that for someone who's maybe a bit more conservative, who's contrarian and not worried about chasing the latest hot theme, SCHD is a great portfolio core. And, I don't use it, but I'm not against it. If I was stuck on a desert island and I could make that decision beforehand from these three, yeah, that'd be my pick.
And just as importantly, not having SpaceX regurgitated upon you. Correct?
Yeah, I don't want to be the exit liquidity for everyone who had shares before the IPO. I don't want to be like exit liquidity for XOVR. I don't want to be exit liquidity for DXYZ. Like, no, that's not me.
Mike, your final chance to weigh in with your overall winner.
Well, I'm not quite as, I guess, in tune with the hatred for the Qs as Tony is, but I get it. It is clearly just a tool that weights their index. I think SCHD is the best play if you have to hold one of these products. It's the most diversified. I think a value tilt is going to be a smoother ride. The market does tend to go in big cycles. People forget how long it took the Qs to get out of the tech bubble. I don't, because I graduated in 1999, started investing in my 401k just like I should, maxing it out from day one. And from first time I earned money in my 401k was in 2012. I went through 2 major market corrections, but I kept allocating along the way, and man, it's been great ever since. But I do think, we get a little carried away with these cycles. However, I do want to point out one thing on this storyline with SpaceX or whatever it may be that gets added to these. One of the reasons the Qs has done so well, and I just looked it up while we were talking, over the last 10 years, the Qs is the number 2 percentile out of 793 ETFs and mutual funds over the last 10 years. But part of that is also because it doesn't have the same rules like the S&P 500 does. So think about Tesla. Tesla got added to the Qs way sooner, and didn't qualify for the S&P 500. Amazon, if we go back to like Amazon, how long did Amazon take to make money? And Amazon is one of the best performing companies. I'm not suggesting that an index shouldn't have rules around that. There's better ways, whether it's through active management or buying it directly yourself. But part of the reason some of this outperformance has happened, especially over the last decade, 15 years, is because these growth funds have ignored that fundamental story, have ignored the the fundamentals, and it's paid off for them. They grew into those fundamentals. So I agree with Tony on terms of index construction, but I don't want people to think that I shouldn't own something just because it's not profitable in the market, because I'm not making a call on SpaceX. I don't know all their business lines and everything else. I do know I love it when I'm on United and they have, what's their satellite? I can't think of it right now. The satellite service they have, Starlink. Thank you very much, Tony. I do think you have to be there. There's a reason to own a little bit of everything, and that's the idea of an index. But you got to be careful with something like SpaceX, which is going to be a $2 trillion company on day one. That's not owning a little, that's owning a lot. And I think to Tony's point, that is truly exit liquidity, being the unsuspecting retail investor. And I agree with his points 100% on that. Just want to caution against the idea of only owning companies because of their financials.
Great I think point. The principal thing for NASDAQ to do would have just been to stick by the previous rules and include SpaceX when it's eligible to do so.
Agreed.
This change ahead of time, as soon as the IPO was announced, basically, it's just so blatantly self-serving and transparent. Like,
well, it's also changing the rules in the middle of the game. You know.
Yeah.
So
and now S&P's looking at doing it too, which is mind-boggling.
Monkey see, monkey do. It's been working. Well, great analysis on both sides, and according to my battle scorecard, our judges have spoken, and today's. Gosh, I don't even know how to score this. I know Tony was SHD, and Mike, I have no clue what you. I guess
on an island, I'm going to own SCHD. If I can't look at my phone again for 10 years, and my money has to be in one of those 3 tickers, it will be an SCHD.
Okay, that's what I thought. And by the way, we also had a wild card mention with those multi-diversified or multi-asset class approach, those iShares series, AOK, AOR, and AOM. Thank you for mentioning those, Mike, as your wild card choice. And our judges rate some great points. So what do you think, audience? Hit us up in the comment section below. I know you've got some thoughts and opinions about today's episode. Great job to Tony and Mike for your outstanding analysis. We couldn't have done it without you.
Thanks, Ron.
Thanks, Ron. It was fun. Good work, Tony. It was good stuff.
Be sure to hit the description section below for links to our program sponsor, Direxion. Also, hit us up in the comments section with your ETF battle requests. Give me your exact ETF ticker symbols. I'm Ron DeLegge. Thanks for watching ETF Battles. We'll see you on the next episode.